Okay, we're back between two fiduciaries here. Jim and Jeremy from On Track Wealth Management. This week we're going to tackle capital gains distributions. All right, Jimmy. So the first thing that we got here this is from Morningstar. They've done a great article where they put out all of these capital gains distribution estimates. And they cover the full litany of different funds that are out there. This particular one happens to be from John Hancock. We just chose this as one of the examples. Walk me through what you're seeing here.
Yeah, so this is a very normal, commonplace exercise for mutual funds. On an annual basis, the portfolio managers have had to buy and sell stocks and funds stocks and bonds in the various mutual funds that they manage, and there are potentially gains and losses that are recognized in those mutual funds. The mutual funds themselves do not pay the tax bill; they pass it through to the shareholders. So each year, it's typically around this time in November that they start putting out estimates for potential capital gain distributions, which are most commonly paid in December. So what we're looking at here is an estimate of their projected distributions for 2022.
Good. We've got another example that we're going to take a peek at as well. This one here is from T. Rowe Price. Just pointing out that we've got the double-digit numbers here identified. Those are some big capital gain distributions that people are going to have. People are going to have these regardless of whether they made a trade in this account or not, right?
Yeah, that's a really that's a difficult part about this conversation with clients. If you hold some of these funds in your account and you're to look at the 2022 performance, you're going to very likely have a down year and negative performance. Yet you're still going to get a capital gain distribution because of the way mutual funds function, and they don't pay the tax bill; they pass it through to their shareholders. So you've got long-term gains that are going to be now passed through in a year where the market's down. That's a really difficult conversation to have with clients.
So the implication here is there's some sort of tax liability that people are going to realize. Here is straight from the Internal Revenue Service is the long-term capital gains rates that people would pay associated with these distributions. And you've got the single filers, the married filers, and there's a couple different rates here. 15% is where most people lie, right?
That's right. Yeah. So I think this is also an important point to highlight here is that the capital gains tax rates are, have a rate or have a rate structure similar to your marginal rate, where they increase as the income increases. So you could actually pay capital gains tax at all three rates that you see there. But yes, these are the tax rates. And this is something that everybody should be taking into account when they're, assessing their portfolio.
Having done a lot of these analyses in the last few weeks, we've seen examples that are much more egregious than this particular one here. But the example is simple: 100K in mutual funds with a 10% capital gain distribution. Your tax liability is likely to be $1,500 plus.
And that's only on the federal side. We're not even talking states. Different states have different tax rates as well, so you got to take that into account in addition to the federal rates.
So here are some things to consider doing. Number one, review your accounts to identify these, what we call tax bombs.
Right.
Number two, you can consider selling these mutual funds prior to the distribution date, right?
That's exactly right. Yeah. So one of the interesting parts of this, depending on the account type that you own these investments in, if you own this in an IRA, it's not nearly as concerning because you won't have to pay tax on it. But if you own this in a non-retirement brokerage account, these tax bills can add up very quickly. And there might be an opportunity for you to sell this fund before the distribution is paid out in 2022.
Also, tax loss harvesting to offset those gains, that's an effective strategy.
Especially in 2022, where you've had a year where, basically every asset class is down for the year. There is likely to be opportunity within somebody's portfolio in a non-retirement account to harvest some capital losses.
And as you mentioned before, strategically choose or look to establish ETFs or SMAs over mutual funds in those non-retirement brokerage accounts. That's just a better approach.
Yeah, that's key. We talk about tax location a lot here at On Track, and this is something that we've proven we can add a lot of value to clients by utilizing strategies like this in non-retirement accounts.
Well, that's all we have this week, folks. Thanks for tuning in for another version of Two Fiduciaries.